Say the name Warren Buffett, and you're likely to conjure images of a legendary investor and one of the world's wealthiest individuals. This self-made billionaire is the mastermind behind turning Berkshire Hathaway from a struggling textile company into a behemoth valued at over $700 billion. His astute long-term investments in companies like Coca-Cola and American Express are the stuff of Wall Street legend. Accumulating a personal net worth of over $100 billion, Buffett has made his fortune largely through value investing, a strategy that involves buying stocks that appear underpriced by some form of fundamental analysis. This knack for recognizing value and predicting market trends has earned him the moniker, the Oracle of Omaha. From his humble beginnings in Omaha, Nebraska, Buffett has become a beacon of success in the world of investing, demonstrating that with the right strategies and a keen eye for value, anyone can achieve incredible financial success. Born in Omaha, Buffett's fascination with numbers and investing started at a tender age. His early life in the heart of America during the 30s and 40s was a testament to his remarkable entrepreneurial spirit. As a child, he displayed unusual business acumen, whether it was delivering papers on his bicycle or setting up pinball machines in barbershops. These were not just ways to make pocket money, but stepping stones that would lead to his future empire. His father, a stockbroker, played a pivotal role in shaping young Warren's life. He introduced him to the world of finance and investing when Warren was just 7 or 8 years old. It was as if a spark was ignited. The young boy was hooked, and he began devouring financial reports and balance sheets like they were adventure novels. This fascination with numbers and the financial world wasn't a fleeting childhood fancy. Instead, it was the beginning of a lifelong passion. By the time he was 11, he had bought his first stock. Yes, you heard it right, 11. That's when most kids are trading baseball cards, but not Warren Buffett. He was already dipping his toes into the world of investing. His early childhood was also marked by his voracious reading habits. One name that had a profound impact on him was Benjamin Graham. Warren considered him his mentor, almost a father figure, and his book, The Intelligent Investor, became his investment Bible. This was where he learned the fundamentals of value investing, a philosophy that would become the cornerstone of his investment strategy. Warren's childhood and early life were not just about numbers and investing, they were about perseverance, about learning from failures, and about developing a keen understanding of the business world. These experiences were instrumental in shaping his mindset and his approach towards investing. His early experiences shaped his investing philosophy, laying the foundation for his future success. Buffett's pursuit of knowledge took him to the halls of Wharton, University of Pennsylvania, and later Columbia. Here, he garnered a bachelor's in business and a master's degree, respectively. But the classroom wasn't the only place where he honed his skills. His real education in investing was a blend of self-study and mentorship from the renowned Benjamin Graham, the author of the celebrated book, The Intelligent Investor. Buffett was not just a student, he was a disciple. He spent countless hours poring over financial reports and learning the principles of value investing. This wasn't merely an academic exercise for him, it was a passion, a calling. His relationship with Graham went beyond the typical student-mentor dynamic. It was this connection that further shaped his understanding of value investing. In essence, Buffett's education wasn't confined within the walls of a classroom. It was in the real world, under the guidance of Graham, where he truly learned the art of investing. His education and mentorship under Graham shaped his core value investing principles. Buffett's journey to success wasn't without its bumps. The path to becoming one of the richest people in the world, as you can imagine, was not a straight line. It was a journey filled with early entrepreneurial ventures, lessons learned, and a few bumps along the way. After completing his business studies, a young and ambitious Buffett dived headfirst into the world of business. He formed several partnerships, each with a unique focus and strategy. However, not all were successful. These early ventures were a mixed bag, with some proving fruitful, while others ended in failure. Yet, each experience provided Buffett with invaluable lessons that would shape his future approach to business and investing. But it was the formation of the Buffett Partnership Hedge Fund that truly marked the turning point in his early career. This venture was different. Here, Buffett applied what he had learned from his previous ventures combined with his unique understanding of value investing, a concept he had studied under his mentor Benjamin Graham. The results were nothing short of astonishing. By focusing on undervalued stocks, conducting meticulous research and holding on to those stocks for the long term, Buffett was able to generate incredible returns. Over a span of 13 years, the partnership generated a return of 200%. This was the venture that made Buffett his first fortune and laid the foundation for his future success. Yet, it wasn't just the money that mattered. These early ventures taught Buffett the importance of perseverance, the value of thorough research, and the power of long-term investing. These lessons, learned in the crucible of early business ventures, would serve as guiding principles for Buffett as he moved on to his next ventures. Buffett's focus on undervalued stocks and holding long-term led to incredible returns. His early business ventures, although varied in success, laid a solid foundation for what was to come. They were the stepping stones to his future success, shaping the man who would become known as the Oracle of Omaha. In the 1960s, Buffett transformed a struggling textile company into his primary investing vehicle. This was Berkshire Hathaway, a name that would soon become synonymous with the world of investing and long-term wealth creation. Buffett's initial encounter with the company was not born out of a desire to own it, but from a business maneuver gone wrong. He had planned to sell his shares back to the company but felt slighted by the management's offer. In retaliation, Buffett began buying up more shares, eventually taking control of the company. But Berkshire Hathaway at the time was a far cry from the investment powerhouse it is today. It was a struggling textile firm, barely making ends meet. The textile industry was on the decline, and many questioned Buffett's decision to invest in such a business. But Buffett had a vision that extended far beyond the company's textile operations. He began to use Berkshire Hathaway as a holding company, purchasing shares in undervalued insurance firms. This strategy was ingenious. Insurance companies by nature hold large amounts of float, premiums collected but not yet paid out in claims. Buffett saw this float as a vast pool of money that could be used for investments. The first insurance company he bought was National Indemnity. This was followed by the acquisition of Geico, a move that would turn out to be one of the most profitable in Berkshire's history. These insurance companies became the primary drivers of growth and cash flow for Berkshire Hathaway. Buffett's strategy was simple but powerful. Buy undervalued companies, let them operate independently, and use their profits to fuel further investments. This was a radical departure from the traditional approach of heavy-handed management and frequent trading. Berkshire Hathaway, once a struggling textile firm, became a powerhouse under Buffett's leadership. It's a testament to Buffett's vision and his unwavering belief in the power of value investing. And it's a reminder that even the most unremarkable beginnings can lead to extraordinary outcomes. Buffett's investments in Coca-Cola and American Express are a testament to his long-term investing prowess. It's a fascinating tale of patience, wisdom, and the power of value investing. In the mid-80s, Buffett saw an opportunity in Coca-Cola, a company that had been around for almost 100 years. He recognized the power of their brand and their global expansion potential. Buffett purchased a significant stake in the company, and the rest, as they say, is history. The investment has grown by an astounding 8,000%, transforming a sizable investment into an enormous fortune. But Coca-Cola wasn't the only company to catch Buffett's discerning eye. Back in the 60s, American Express found itself in a financial pickle due to a failed business venture. The company's stock plummeted, but Buffett saw beyond the temporary setback. He saw a strong brand with a robust business model and a loyal customer base. So he invested heavily. And over the decades, this investment has also multiplied several times over, adding billions more to his net worth. These investments, among others, highlight Buffett's willingness to hold on to companies indefinitely, based on the principles of value investing. He doesn't look for quick wins or short-term gains. Instead, he seeks out undervalued companies with solid business models and the potential for long-term growth. And once he invests, he sticks around, often for decades, watching his investments grow and multiply. This approach, while seemingly simple, requires a deep understanding of business fundamentals, a keen eye for value, and an extraordinary amount of patience. But as Buffett's track record shows, it's an approach that can yield incredible results. So what's the secret to Buffett's success? It's not some complex investment algorithm or insider trading secrets. It's his commitment to the basics: find value, invest, and hold. And as his investments in Coca-Cola, American Express, and many others show, this straightforward strategy can lead to extraordinary returns. Buffett's long-term investments have yielded incredible returns, making him billions in the process. Over the years, Buffett has transformed Berkshire Hathaway into one of the largest public companies. To truly understand how this transformation happened, we need to delve into Buffett's unique approach to business. Buffett's strategy was simple yet ingenious. He used the premiums from his insurance businesses as a cash reservoir. These reservoirs were then deployed to purchase entire companies, creating a network of wholly owned subsidiaries under the Berkshire Hathaway umbrella. This was a paradigm shift in how businesses were run, and it was all driven by Buffett's vision. This wasn't a haphazard process, though. Buffett would meticulously select companies to acquire, focusing on those that were undervalued, yet had strong growth potential. His eye for value and potential is what set him apart from his peers and allowed him to build Berkshire Hathaway into the behemoth it is today. But buying companies was only part of the equation. Once under the Berkshire umbrella, these companies were managed independently by their original management teams. This hands-off approach allowed these businesses to operate as they always had, preserving their unique cultures and practices while benefiting from the financial backing of Berkshire Hathaway. Take, for instance, Geico, an insurance company that Berkshire Hathaway fully acquired in the late 90s. Buffett didn't step in and try to overhaul the company. Instead, he let it operate independently, trusting in the expertise of the existing management. This trust paid off, as Geico has since become one of the leading auto insurers in the United States. This strategy was replicated across the various companies Berkshire Hathaway acquired, from See's Candies to Dairy Queen, each one adding another piece to the Berkshire conglomerate puzzle. The result? A vast network of companies spanning various industries, all contributing to the overall success of Berkshire Hathaway. Buffett's precise capital allocation and hands-off management style have become the core of the Berkshire model. His ability to recognize value and potential, coupled with his trust in the existing management of his acquisitions, has allowed him to transform Berkshire Hathaway from a struggling textile company into a global conglomerate powerhouse. Warren Buffett's journey from a small-town boy to a billionaire investor is a testament to his investment acumen and principles. His early fascination with numbers and finance, fostered by his father, established the bedrock of his investment philosophy. His education, though formal, was enriched by his insatiable appetite for knowledge, learning from the wisdom of legendary investors such as Benjamin Graham. Buffett's early business ventures, though fraught with challenges, paved the way for his remarkable success with the Buffett partnership. His transformation of Berkshire Hathaway from a struggling textile company into a powerful investment vehicle, and his strategic investments in undervalued insurance companies are hallmarks of his savvy business instincts. His long-term investments, such as Coca-Cola and American Express, underscore his commitment to value investing, a principle that has guided his career and yielded incredible returns. Warren Buffett, the Oracle of Omaha, continues to inspire investors worldwide with his timeless wisdom and unparalleled success.